Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Hello, I'm Ryan Edwards. I'm sitting here today with Les Stewart. We're happy to have you here joining us on the Southeast Retirement Planners Podcast. For those of you that know us, we're located in our headquarters is in Hickory, North Carolina, and inside of Moretz Mills, and we work with individuals across the state of North Carolina and various other states. And you can find us and our podcast and our videos certainly on our website at www.seretirementplanners.com, and then you can reference our past podcast not only on our website but also on Spotify, Google Podcast, and YouTube as well. We do these from quite often on various topics, and today we're happy you're able to join us here as we film this. It is March the 1st, and a lot of stuff's been going on in the markets.
Oh, yeah.
And,
it's been some interesting times.
Yeah, so we're going to be talking about being a student of the market and basically volatility that's going on in the market right now.
Yeah, I was looking through some resources, trying to stay up to date on what's going on and how to, best communicate with our clients about what's going on and where they should go. And we ran across this presentation that BlackRock's put out, Student of the Market, and there's some really good slides in there that's been really helpful to put things in perspective. And we just thought it'd be a great topic to talk about, timely topic with there's a few things going on right now.
Well, I mean, as this presentation came out, obviously we're in the middle of Russia invading Ukraine right now.
Right. And the media's just flooding us with that information, which I'll be honest, I'm very interested in and captivated by what's going on over there myself, and hope the best for those folks. Yes. War's not good for anybody, but we're getting a lot of questions about how's that affect my investments.
Exactly, and we're in the middle of reviews and been talking on the phone to a lot of people as well, and even for individuals like ourselves that are in the business, 2021 was a year of pretty much good returns in the stock market.
Sure, it was great returns
and low volatility. Mm-hmm. And even individuals like us kind of get that are around it all the time. We certainly like up markets just like anybody else, but it's quick. You're sometimes quick to forget that the times we're going through right now, especially at the beginning of 2022, while they are uncomfortable, they're not unfamiliar. And that's
you mean the market doesn't go straight up all the time?
Does not go straight up, and as we go through periods of low volatility, unfortunately, as investors in general, forget that market corrections are a part of a normal market cycle, a normal market. And we've had low volatility, and volatility has certainly increased. We're referencing this page right here, staying the course versus in market volatility. It pulls out various times the market crash of one day in 87 all the way through the it's extracted all the way back since 1950. It goes back and it shows bad periods of decline during the market and what the returns were 1 year later.
Yeah, so some familiar events to people that have been around, especially as long as we have, the Black Monday, the first Gulf War,
the tech bubble.
Tech bubble. That was right when you got into the business, right?
It was. It was coming on right afterwards, and then we actually started our own firm during the financial crises.
That's right.
And then we've been part, obviously, of the trade war and now the COVID-19 sell-off, and we're still here. And the thing is, the market's up higher than it was when 50 was here as well.
That's right. And, we're not sitting here telling you that those were pleasant times to be an investor. They certainly were not. Anytime, for example, the financial crisis, when you see a negative 56% return in the S&P 500, those are certainly make you think about what your strategy is and if it's right. So, the key to that is strategy and sticking with your strategy, and that's proven to pay off, just as this slide has shown. During the worst decline in the market in the last several decades, preceding that, coming out of it on the other side, you saw in the S&P 500 a plus 68% return. So.
And you mentioned strategy, but I'm going to add one more thing to that, and that's communication, because a lot of people forget their strategy during periods of time. We don't want individuals to be normal investors, and unfortunately, time has proven that the normal investor sometimes wants to buy high and sell low, and we don't want our clients to be the normal investor.
Right.
We want to communicate in a way that they know how their portfolios are going to react potentially in a down market and as well as an up market, so that they can follow that strategy, because the market doesn't always go up.
Right.
And we're in the middle of that communication and trying to stay in front of it with our clients as well. So if you, I'd encourage you that if you're working with someone outside of our firm, make sure you're having those conversations. You don't feel like you're having good enough communication, please reference us and come in for a complimentary financial checkup. I'll give a little plug there, but I think that's more than appropriate and very important for an individual.
Yeah, and it always helps to have someone else's opinion, someone that can kind of look at things from another point of view that you just may not see. We get so focused in our daily lives about, here's what I'm trying to accomplish, and anything that might throw you off course really mixes your mind up about things. And it helps to have an outside voice to say, you might want to look at this, or this is really what you're trying to accomplish, and not worrying about, daily and minute by minute activities, think about the big picture. And that's one thing that we always try to do.
Correct. And as we go to the next slide, we've got, basically building a portfolio, as it said, that's right side up. And BlackRock has put together this slide that just, helps you focus on the importance of staying the course, that you can capture more upside than downside if you have a long-time buy and hold versus a long-time buy and hold portfolio.
So, the takeaway here is there's no one portfolio that's perfect for everybody out there. But there is, mixing asset classes, getting good diversification always helps you kind of weather storms. It makes it not quite as violent, and also gives you, better results on the other side. So not experiencing those dramatic down times, but also, you're probably going to give up a little bit of the dramatic upsides when you've got a good asset mix as well. But over time, being consistent pays you. That's basically exactly in most cases.
That's exactly right. And I misspoke earlier, but just before when I introduced this slide, but this one is particularly focusing on helping you build, a portfolio that can capture more upside than downside, to help you build a long-term kind of buy and hold, and working through those time periods which we just referenced, and staying the course, as you mentioned. So as we move forward, it is said by the Federal Reserve that we're looking at being in the 2022, we're going to have 3 interest rate hikes.
Yeah, so that's another thing that's weighing on investors and markets is this thought that the Fed's going to come out and raise interest rates this year, and that's how's that going to affect stocks and bonds and all that, my money,
right. So. And they're doing that to head off inflation, which is at 40-plus year highs. And now, since this is, I don't. In my personal opinion, I don't think they're going to stray away from these interest rate hikes. However, they may be delayed slightly, because since this was produced, we're in the middle of the Russia-Ukraine.
Well, we get inflation from different ways, and the inflation numbers that the government puts out doesn't always include, for example, like the price of gas,
Correct.
Or the
Correct.
price of. But it's a good indicator of what's happening, and it's past looking really a lot of times.
Right.
But like gasoline is due to this Russian-Ukraine conflict. That's where a lot of the world gets fuel from, and we're seeing prices at the pump and also prices in industry for fuel go up, and that's a form of inflation, right?
Yes,
and
it
that's
is. Yes,
and
it is.
that gets passed on to the consumer. Businesses usually don't keep their prices the same because if you don't make a profit, you usually go out of business, right?
Yes, exactly.
So they're passing that on. That's inflation to us. So it's kind of happening without the interest rate hikes quite as much, but it's still, inflation's pretty high. There's a lot of money out there being put to use, and it may be appropriate for the Fed to act, but I think you're right. I think that they're going to take a second look at that decision.
Right. As we go forward, and we'll reference the inflation a little bit more here in a few minutes, but as we go forward, and just wanting to make sure we touch on several things. How much the Fed raises rates is key. And that is another question. A lot of individuals, or in the past, they were dropping it by 25 bips or 0.25 of 1% or 50 basis points. And this slide just simply, they'll do it in 25 basis points increments. So it's either 25 bips or 50 bips or 75 bips or 1%. Now, I don't think we're going to see a 1%. I don't think that's being talked about. What's been floated around is a 50 bip increase. But the main thing they've kind of committed to is 3 interest rate times during the year that they're going to increase interest rates. Now, what we don't know is how much.
Yeah. But we've been sitting at very low interest rates for a long time.
And we've been repeating that for at least, it feels like forever.
Yeah.
Not forever, but it does. Now, this is just referencing, what particular sectors, how they've performed during time periods where the Fed has raised rates, and it's been a good time period over time for stocks, a majority of the time.
Right. It hasn't really negatively affected stocks most of the time. But we don't. A lot of times we approach discussions when we say the market. We're talking about stocks and equities,
right.
But we have a lot of people are invested in bonds, and bonds are good investments out there. But people are questioning whether, with an interest rate hike facing them, should I be in bonds?
Right. If you haven't looked at your portfolio, you really need to take a look, and we do this all the time, is long-term bonds.
Right.
Those out in maturities are going to be the most affected by an interest rate increase.
So how that works, kind of take a step back, is, when interest rates go up, bond yield
seesaw
change, and generally a bond that you're holding may go down in value when there's other bonds on the market with a higher rate.
Right.
It's a supply and demand thing. But as you can see, it doesn't always mean a negative effect on your bond portfolio. You can see here there were 3 rate hikes in 1999, and there's several cases like this. But there was U.S. bonds 3.5% return that year,
in
right?
2017. In 2017.
In 2017, yeah.
And even it was a very slight downturn just overall to bonds in 99. But there's been good years in 95, 1 rate increase, and it proved very beneficial, double-digit returns.
Right. So, makes the argument that bonds can still be a valuable part of a diversified portfolio.
Yeah, and that diversification is really the key. And as we go and move forward, this is the one thing I told you we'd come back to here in a second, is the, where is inflation, and how much, what is really the breakdown, and what are making the headlines And this is for changes shown below or for over 12-month period ending at the end of last year, meaning 12/31/21. And it talks about, housing, a broad category change, up 5.1%. Food up 6%, medical care up 6%, transportation up 21%. That means, what is that? Well, that's car and truck rentals.
That's amazing. 36% increase in the price of car and truck rentals.
That's right. Sport, biking, that became a big thing during COVID when everyone was locked down and coming out. And as we've recovered, is recreation up 3.3%, but the specific sporting vehicles such as kind of a subcategory in that broader category is up 7.8%.
Right. So, kind of with the low interest rates that we've had so long, we haven't really seen a huge jump in inflation. Inflation's probably been below average over the last decade. And what we're seeing is kind of catching up a little. Part of this is just catching up to it. There's some other things. The pandemic could have affected the price of items, through supply chain issues and things like that. Everything that a lot of things that we've read and hear are inflation should start kind of leveling off
at the end of the year. Yeah, exactly.
It's not like we're going to go up at 7% every year going forward. You can't sustain that.
And what's your normal everyday expenses? I mean, that, food and gas, you can see that there's no, it says transportation, they're not talking necessarily about gas in that category.
Right.
It's not something that normally comes up in the CPI index. But food, that's food and gas are two of my biggest expenses with, two boys, taking them around everywhere and then feeding them. And I know you have the same feelings as well. Food's up 6%, but there's individual subcategories: meat, fish, poultry, and eggs. It's up 12.5%. So that's why the old grocery bill has certainly increased, to say the least. And even restaurants, they're having to pass that increase on to their
there's so many factors
to their patrons.
We could spend an hour just talking about how all that all plays together, and it's really interesting. But labor costs, gas prices to deliver food, it all plays a part, and it's just kind of all coming to a head. But that doesn't mean that there's not profitability in corporations out there right now. So.
Earnings, as we said here, the earnings have been very good.
Right.
So that's just some interesting information, things that are weighing in on the market, but at the same time, I'll go back to my statement. I've been using it a lot. As we're here, while it is uncomfortable, it is not unfamiliar.
Right. And also volatility can be a good thing for investors as well. And most of us that are in the work world are contributing to our 401ks each pay period or whatever our retirement savings vehicle is. And if you're not, you should go talk with somebody about finding a vehicle. But you're putting in on a regular basis each month or every 2 weeks or each week or whatever, however your pay period is, into those investments, and you're buying during this time of volatility. So if it's a day that the market's down or a week that the market's down, you're buying cheaper than you could have a week before that, right? Right. And that's a good thing. And over time, historically, the market has rewarded people that stay the course during that. So
it is, and for those that are retired that aren't necessarily put money in, it's a good opportunity for us to rebalance and rebalance one's portfolios, and that's some things that we've been doing as well. And some of the equities that have gone down, some of the allocations are a little bit not like what they're supposed to be. So we're going in and rebalancing portfolio as well. And those individuals that have some money maybe on the sideline, it could potentially be an opportunistic time if it fits their specific criteria to purchase in.
That's
Things
right.
are at a lower price.
So, I think we've shown that the markets are not going to end tomorrow, most likely. You never know anything for certain. But
we have more stuff to worry about if that occurs.
Right.
I'd certainly think.
And but there could be opportunity. There's always opportunity in every situation. It's just you have to look for it, and making sure that your philosophy and strategy is on pace and you stick with it is probably the key to a successful investor in times like these and other times as well.
Right. And so as we wrap up today, I would just encourage you, as you look at or listen to this video / podcast or podcast / video, is that the slides we mentioned may certainly change, and the economic headwinds that we face may change, but some of the items which we've mentioned, the approach to times like this in the market, the approach to volatility in the market, they are some core principles to being a good investor. And that's what, even if you listen tomorrow or you listen in 6 months, there's still value in this and those philosophies.
Right.
Now, that's what we're here for, is to make sure that we align our investors, our clients, with the way that fits their needs most appropriately. So we're here to do that. And if you are listening and you're a client of Southeast Retirement Planners, so we appreciate the trust, and we look forward to continue to work with you. For those individuals that are new and just finding out about us and our firm, you can find out more about us at seretirementplanners.com. You can look at our services, find out more information about our team, and look at also and listen to our videos that are on one of the tabs on our home screen.
Yeah.
So on behalf of Southeast Retirement Planners, we'd encourage you to look us up on YouTube, look at us on our website, join us on Spotify and Google Podcasts, and learn more about us and get some good information. So I'm Ryan Edwards once again, and Les Stewart. So on behalf of Southeast Retirement Planners, we thank you for joining us and hope you have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.